Most people go to sleep, believing the markets are calm, predictable, and under control. They check their portfolio before bed, maybe glance at the news, and assume tomorrow will look a lot like today. Then morning comes, screens turn red, prices gap down, billions vanish before breakfast, and everyone asks the same question in panic and disbelief. How did the market collapse overnight? What makes this even more disturbing is that these crashes never feel random after the fact. Analysts suddenly have explanations. Experts suddenly sound confident. Headlines pretend the warning signs were obvious. But if the signals were so clear, why didn't Wall Street warn everyday investors in advance? Why do markets collapse overnight when most people think everything is fine? The uncomfortable truth is this: overnight market collapses are rarely accidents. They are the result of hidden triggers, silent pressures, and structural weaknesses that build quietly while attention is focused elsewhere. By the time the collapse becomes visible, the damage is already done, and the smartest money has often moved first. Here's the first reality most investors don't want to hear. Markets don't crash because of bad news alone. They crash because of surprise. When fear appears suddenly, liquidity disappears just as fast. Overnight hours are especially dangerous because that's when trading volume is thinner, reactions are faster, and automated systems dominate price movement. A single unexpected event during off-market hours can trigger a chain reaction before human decision-making even has time to catch up. One of the most powerful hidden triggers is leveraged positioning. During bull markets, leverage quietly increases. Hedge funds, institutions, and even retail traders borrow more to chase returns. Everything looks stable as long as prices keep rising. But leverage is like dry wood in a forest. It doesn't cause the fire. But when a spark hits, the fire spreads instantly. Overnight, margin calls begin. Forced selling accelerates. Algorithms detect weakness and amplify it. By the opening bell, the collapse feels sudden, but the conditions were building for months. Another trigger Wall Street rarely highlights is liquidity illusion. During calm periods, it feels like markets are deep and liquid, that you can buy or sell anything at a fair price. But liquidity isn't constant. It vanishes when everyone wants to exit at the same time. Overnight sessions expose this weakness brutally. Fewer buyers, wider spreads, and aggressive sell orders can push prices far lower than anyone expects. What looks like a collapse is often the market revealing its true depth, or lack of it. Global interconnectedness is another silent accelerant. Markets don't sleep anymore. A political shock in Asia, a banking headline in Europe, or a currency crisis in an emerging market can ripple across futures markets instantly. By the time US and UK investors wake up, the damage is already priced in. Wall Street didn't warn you because the trigger didn't originate where most people were looking. The world is now one continuous trading system, and overnight is when the cracks travel fastest. Then there's the role of algorithms and high-frequency trading. These systems don't think, they react. They are programmed to respond to volatility, price momentum, and risk thresholds. When one algorithm starts selling, others follow. Feedback loops form. Human emotion isn't required for panic anymore. Machines can create it on their own. Overnight hours, when human participation is lower, give algorithms even more influence. A small move can become a free fall before anyone steps in. Interest rates are another underestimated trigger. Central bank policy changes don't always hit immediately. Markets digest them slowly, often incorrectly. Investors convince themselves that rate hikes are priced in, or that cuts are coming soon. But overnight, a single statement, data release, or unexpected comment can shift expectations instantly. Bond yields jump, equity valuations reset, growth stocks get repriced, and suddenly, the market opens deep in the red, with no obvious warning. Fear spreads fastest when confidence is fragile. Late-stage bull markets are especially vulnerable. Prices are high, expectations are extreme, and bad news is ignored until it can't be anymore. Overnight collapses often happen not because conditions are terrible, but because they were unrealistically optimistic. When reality intrudes, the correction is violent. Wall Street doesn't warn you because optimism is profitable right up until it isn't. Media behavior plays a role too. Financial media thrives on momentum, not caution. During rallies, risk gets downplayed. During calm periods, warnings don't get clicks. But when markets collapse overnight, fear suddenly becomes the headline. The same outlets that ignored early signals rush to explain the damage. This creates the illusion that crashes are unpredictable, when in reality they are just inconvenient to talk about early. Retail investors are often the last to react because they are trained to think in narratives instead of structures. They look for stories, earnings, headlines, personalities. But markets move on, positioning, liquidity, and risk exposure. Overnight collapses happen when those structures break, not when a single story changes. By the time the narrative catches up, prices have already adjusted. Another hidden trigger is correlation risk. In stable periods, diversification feels safe. Different assets seem unconnected, but during stress, correlations spike. Stocks fall together. Crypto moves with equities. Bonds fail to hedge. Overnight shocks reveal that many portfolios are built on false assumptions. Everything people thought would protect them suddenly moves in the same direction. Psychology matters more than most people realize. Overnight collapses exploit the human fear of uncertainty. When investors can't react immediately, anxiety intensifies. By the time markets open, panic selling often replaces rational analysis. Wall Street understands this dynamic very well. Silence during the night isn't ignorance. It's part of the system. History shows this pattern again and again. The 1987 crash accelerated outside normal trading hours. The 2008 financial crisis saw massive overnight moves driven by banking fears. The COVID crash featured brutal futures sell-offs while most of the world slept. The triggers were different, but the mechanism was the same: leverage, surprise, and vanishing liquidity. If you want to understand why markets collapse overnight, you have to stop looking for a single villain. It's never just one thing. It's the combination of fragile positioning, overconfidence, automated reactions, and global linkages. Wall Street doesn't warn you because these forces are baked into how modern markets function. Here's the part most people don't talk about. Smart money watches overnight markets closely. Futures, options flow, volatility indices, currency moves, and bond yields all send signals long before headlines catch up. While retail investors sleep, professionals are adjusting risk, hedging exposure, and preparing for the collapse. Feels sudden only if you're not watching the right places. This doesn't mean crashes are easy to predict, but it does mean they are rarely completely invisible. The warning signs are just uncomfortable. Rising volatility without falling prices, narrow market leadership, excessive leverage, extreme sentiment, tight liquidity. These aren't exciting topics, so they get ignored until they matter. The biggest mistake investors make is assuming stability is the default. It isn't. Markets are inherently unstable systems held together by confidence. Overnight collapses happen when that confidence breaks faster than people expect. Wall Street doesn't warn you because confidence itself is part of the product being sold. If you're still watching, here's the key takeaway. The goal isn't to predict the exact night a market will collapse. The goal is to understand why it can happen at all, and to position yourself so you're not emotionally or financially destroyed when it does. Awareness beats prediction every time. And remember this, the market doesn't collapse overnight for those who are already prepared. It only collapses overnight for those who believed nothing could go wrong. If this opened your eyes, subscribe to the channel and watch the next video to learn how smart investors read overnight signals before the market opens.